Now on this channel, we always talk about earnings season bringing a lot of volatility, but to the degree of what Fiserv has given us today has even given us a bit of a shock. It is down now nearly 70% year to date, making its worst drawdown in its history. And it was due to the earnings. Clearly the market did not like that. One of the things we saw was that they cut their full year profit forecast, which we'll get into, and just today alone it's down 44%, looking very likely it's going to be their worst day ever. And even with the market giving a very red tone today, it's nowhere near the likes of what Fiserv has produced. What makes it even more fascinating for the stock, just this month analysts were calling this a buy with a price target $170. That's what we've noted from UBS. We have Bernstein who believed this company would outperform. In fact, look at the date we're just talking about a couple of days ago. In fact, their own price target was $205, which means right now it would be more than a double if this does come into fruition. And we can go on and on with analysts being incredibly bullish. Another one here who at the beginning of this month gave this company a price target of $188. And on top of that, we've just started to see the inflow of super investors, what they've been buying and selling. And you would never ever guess what is the most bought stock by super investors so far in quarter 3. It is there in joint first position, Fiserv Inc., with 4 super investors adding this to the portfolio. Now look, they clearly saw value in this company, but it is down 42% today. And as we go through talking about why the company's down, the underlying metrics and our own valuation, if you are considering it, well look, you would be buying this at a much cheaper position than those 4 super investors that added to their portfolio. Now we did say it's down nearly 70% year to date, although has started to very slightly recover. Over the last year, down 64, and when we zoom out to the last 10 years, well look at that, not only massively underperformed the S&P, as we'll come to show you, up only 53%, but what a pullback from their all-time highs. We're talking in 2025 at $239. Now it's sitting right at the other end of the spectrum, although as we mentioned, a slight recovery from the drop today at $67. Interesting as well that both Seeking Alpha and Wall Street give this company not only a buy rating at 4.33 and 4.34, but very near the 4.5 that would flip it into a strong buy. One sitting at the other end calling this a sell. So we've got analysts screaming this company is a buy, price targets touching nearly $200, super investors themselves adding. So let's take a close look at this company, and we appreciate we haven't really discussed this for those that maybe are less familiar. Ultimately, it's a global fintech powerhouse, or at least it was, that builds payments and banking technology behind the scenes, powering credit card transactions, digital wallets, core banking systems for thousands of banks and merchants worldwide. And it's slightly different if you're thinking about PayPal or SoFi that you and me use directly. It's the infrastructure behind them. They power the payment rails, banking systems, and card networks that move money for thousands of banks and merchants, so effectively the quiet tech backbone making the fintech world run. And getting into the earnings, EPS came in quite significantly below $2.04, expectation $2.65, so a very large miss, 23%. Revenue also came in under by 8%, and if we're looking at a year-on-year comparison, EPS down double digit, revenue up barely, and even from the previous quarter, we are seeing this company down, which isn't really great. Now, the expectation for this quarter was actually growth of 15% year on year, which we never got to see, and historically, this company did outperform analyst targets. They had a 100% track record, so it should make you a little bit concerned as to whether or not they can actually hit their projection for double-digit EPS growth over the next 3 quarters. And whilst we haven't yet touched upon the valuation, if they do hit the EPS of around $12 into the next full year, the forward P, this hasn't been updated, will be in fact in the single digit, which could look like a screaming opportunity. Now, one thing that also wasn't great in this quarter was their organic revenue growth. In fact, the lowest for nearly 5 years, December 2020, where it was at 1%. Not only very poor, but just look at that drop from last March where it sat at 20%. In fact, it's only been going downhill ever since definitely something concerning, especially in conjunction with the cut to their overall guidance. And if we're looking at their valuation, which did get a D plus before the drop, it was trading at a premium to the sector. Now, in fact, it'll be trading at a discount, and against their own 5-year average, it's going to be even further away, more than negative 32%. Price to earnings growth, which a lot of people like to see, especially when you incorporate the growth of companies in this industry, it's sitting below 1, meaning today it'll be below even 0.81. Remember, we like to see below 2 to get us really excited. The sector was already higher before the drop. 30% discount was what you were getting, and their 5-year average was also higher. You're now getting more than a 37% discount. Doesn't mean you should buy, but just puts things into perspective that this company was already, before the drop from their earnings, trading at quite a hefty discount. It was also even before trading at their lows if you want to look at other metrics like the EV to EBIT. And we're saying all of this whilst the market is going on to new all-time highs. Many companies right across the board, when we're looking at a forward P, are trading well above, in fact, their own averages at levels we would say potentially aren't worth considering, and a price to earnings growth that also holds true for the majority of companies. So maybe Fiserv could be one that actually the market may be overreacting to. And if we look at their guidance now for the full year of 2025, remember in the latest quarter, organic revenue growth was only 1%. They're projecting 3 to 4. Not the greatest in reality. They're also anticipating a drop to their margin. We never like to see this. Deficiencies aren't what we want. High quality companies, they show the opposite. And free cash flow, we'll cover this when we run it through our discounted valuation, but they're projecting 4.25 billion, which is a drop from 2024. We can also see when we look at their investor presentation, we can see revenue is down from the previous quarter. Bit of a downward trend in their operating margin. Never great to see. It was 40.2% in Q3 2024, now sitting at 37%. Like the previous two, also the earnings per share on a bit of a downward trend. Again, lots of definitely concerning things. Question is a 41% drop really justified? And we just want to remind you, this was one that super investors were already piling into. They're also, like most of the S&P, increasing their capex spending. We can see it is up from the same quarter last year. Free cash flow, whilst on a trailing 12 month, is at an increase. We'll come to highlight it is lower than their full 2024 position. And one thing many investors don't like to see them doing is taking on a lot of debt to increase their share buybacks. Some investors may like that, others may not, but we can see from more than the last 5 years, they've been returning a lot of excess cash through share buybacks. But in reality, this isn't what you want to see. You don't want a company spending a lot of money on share buybacks when their share price also is trending in the same way, going down. And yes, you can argue share price doesn't always correlate to the underlying metrics of the company, but unfortunately for Fiserv, all of their metrics are moving down. And free cash flow historically was very strong, sitting at 7.2%, but again, metrics do really need to improve. And whilst we covered what super investors are doing, when we look at the institutions with their 91% ownership, they sold 10 billion in the last year. They bought pretty much twice as much, so you could argue very bullish, they're net buyers. However, in Q3, they actually pretty much bought the same amount as they did in fact sell. So no clear indication in the most recent quarter, but actually if you go back to the most recent point where they sold more, where they were net sellers, you would go to Q2 2024. Likewise, when we consider what insiders are doing with 0.75% ownership, no insider buying in the last year. We do note 22 million worth of selling, and if you want to see when that was, well, Q2 we note some selling, Q1 as well as Q4, although bear in mind, whilst we do highlight insider selling, it's not typically a bearish signal. They sell for many reasons, personal and financial. So the question is this a company that you can really now classify as a growth one? Last year they grew around 7%, which was a little bit below the sector, slower than what they had produced on a historical basis. And whilst initially they were anticipating 7 to 8%, we just saw maximum they're anticipating for 2025 is at the 5% level, which again means they're growing slower than both the sector and their 5-year average. Earnings per share, again, if you can believe they will hit this over the next 3 to 5 years, projecting 15%, which is above the sector, great to see, and slightly above their 5-year of 14.5. And profitability comes in at an A, where their gross margin is 61%, only marginally better than the sector, but massive improvement to their 5-year average. That is good to see if they can keep that trend. Bottom line also very positive at 16%, when we notice their 5-year is at 12.3, but unfortunately the sector overall does have a much better net income margin at 23%. And we should really run through a few key metrics, kicking off with their free cash flow per share. Whilst we have the earnings data available for you to see, we would just highlight it is susceptible to manipulation by management. So free cash flow, we want to see consistent growth over the longer term. That is pretty much what we get, which is very positive to note. The initial projection was in fact an increase over the next 12 months from 875 to 1070, and we'll cover the sales growth, but you can see very, very inconsistent. The last few years, bit of a downward trend in the mid to high single digit area, and then total sales, again, does also reflect no real obvious trend. Some years very strong, some years in fact pretty flat. Shares outstanding, we just flagged, they are in fact doing a lot of share buybacks, which did start from 2020, something they do anticipate to continue, but bear in mind, if they have a lot of cash, they should really put that into the business, especially as it does look like in this shorter term it is struggling. ROIC, great to see an increase from the lows of 2020 and 2019 at 2% to now sitting at 9%. But again, this one, bare minimum we want is 10% to give us faith management are able to effectively allocate their capital. Margins kicking off with the operating, again, nice to see their recovery from the lows at 10% in 2020. Nice upward trend, now sitting at 13%. Free cash flow margin, very positive, very consistent around the low mid-20s. So that is one nice thing, again, if they can keep this up. Net debt to EBITDA, one of our favorite metrics, we do want to see below 3. In fact, this highlights the number of years it would take management to pay off all of their debt net of cash on hand, and it has been decreasing from the highs of 2019, still a little bit high at 2.91, an increase from 2024. Projection is expected to come down in the next year, but again, lots of things we've mentioned today definitely worth either considering when we come to a margin of safety, or to take a look for improvement in their next quarter, where when we do take a look at their revenue, which we did cover not that long ago, they have pretty much quadrupled their top line from 5 billion in 2015 to now 20 billion in 2024. But as always, what we want to understand here is, what is the story the bottom line net income tells us? Does it follow a similar pattern? The answer is, for the large part, yes, going from 700 million 10 years ago to now sitting at 3 billion. But as always, definitely something to check for each company you're either considering or hold in your portfolio, for which we then move on to the health check quick total cash versus total debt analysis, where they've been increasing their cash 300 million 10 years ago, now sitting at 1 billion. But as always, one number here, pure isolation, isn't going to give anything away. So we compare it to their total debt numerically and directionally, which has actually been increasing and quite significantly over the last 10 years. 4 billion 10 years ago, now sitting at 30, well above in fact their cash. Look at it this way, they've got 1 billion worth of cash on the balance sheet, but near 30 billion worth of debt, and that is why we saw the net debt to EBITDA as a little bit concerning. Again, something just to take away, for which we also want to understand, how does their performance compare against the likes of PayPal, Aiden Block, as well as others? Is this an industry-wide issue, or is this essentially a Fiserv problem? And when we take a look, FI down 63% over the last 12 months. In fact, there have been others like PayPal also struggling, but you can notice some haven't performed too badly. But overall, this industry isn't one really you'd want to have been in over the last 12 months. Expanding to over the last 5 years, again, the conclusion is very, very similar. This industry has just not been one where you wanted to park your money in. And over the last 10 years, again, pretty much the conclusion is there. Although you can argue Block has been very strong, up more than 500%. Bear in mind, as always though, past performance is not an indicator of the future, and this could in fact be one of those that does have a very strong rebound. And whilst the answer is very obvious, you can see over the last year it's massively underperformed both S&P as well as the QQQ, for which the conclusion holds true over the last 5 years as well, and in fact the same over the last 10. Bear that in mind, as always, if you are picking individual stocks like Fiserv, you need to have the confidence that you can massively outperform. Otherwise, Otherwise, you could invest in a low-cost ETF that tracks the S&P like VO, or in fact the QQQ. And before we jump into our valuation, we want to let you know we have released our latest free weekly article. We drop one every single Sunday morning to your inbox, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October, lots of information for each one, the upside that Wall Street themselves see over the next year. November's copy will be releasing in the next few days, and you can also grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now we're going to run through our valuation, which gets to $116 derived from the DCF. Now this is using the discounted cash flow model, where we have a growth rate of 5%, average is 23, just look at the last few years, 20% growth, 34% growth, and remember for 2025, we're going to use their projection of 4.25 billion. Now you may look at this and say these numbers aren't what you would put. Well look, we have a low, medium, and high, 5, 10, 15. As always, the numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Fiserv or any others. But the takeaway might even be, now given the price has massively crashed, baked in is no growth whatsoever, or we should say 0.2% year on year to the future free cash flow. So you may look at this already and say screaming buy, massively undervalued. And when we do take a look at the lower rate to date of 5%, which we have used to be conservative, normally we use the medium one, 5% with a discount rate, we get the present value of future free cash flow terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, giving us $116, 61% upside. Now look, you may say that's way too conservative. Well, at the 10% rate, this in fact comes to 177, which was roughly where Analyst did project this company to be. That is more than a double, 146% upside. Or you may go one step further and say, why not 15? The last 2 years were strong double digit, and in fact $260 is the conclusion, which means more than a triple, up 261%. Now let's kick things off by being very conservative at the 5% level. We're not done because, as you know, we want a margin of safety. 10% is what we kick off with, execute if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Well, before we even look at that, this already flashes that we have a 38% margin of safety if you believe the growth rate of 5% to be reasonable. So is it a buy with a 38% MOS? Wall Street see this at 170 into next year on average, more than a double at 136%. And you may be there saying, you know what, let's be even more conservative, no growth whatsoever. Well, in fact, we can see you would be paying a premium of 2%. So it may not look like this is one to consider if you believe their future free cash flow will not grow anymore. But a 5% level, we just flagged, you are looking a 38% MOS. For those that want to see at the middle rate, which is what we do typically use, you are getting a margin of safety of 60%. And for those that believe 15%, we shouldn't be too conservative, a little bit more on the optimistic side, 72% margin of safety. So 5%, bottom line, is this in your view now a screaming buy, maybe a hold, or one to completely avoid? And if you're someone that wants to make note at a 50% margin of safety, sitting at $58. So give us your views on Fiserv today, and don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.